Hi everybody, welcome to another update on the gold forecaster index. In my last video I said gold was still going to go up, but at a slower pace because the gold forecaster index went down a bit. Well, it's been flat, but looks like it's starting to rise. So what is the gold forecaster index telling us now using leading indicators? It looks like the data point is up, as you can see here, still nicely above the zero line, so we should be rising. Gold price should be going up. Misery index going up a bit. I think inflation will come back, unemployment will rise, so that will be good for gold. Productivity has improved, but lately it's declining again. ETF flows looking positive. GLD, a little bit of a dip, and it's pretty stable lately, so no changes here. COMEX starting to rise. LBMA also starting to rise with a few hiccups, so looking good. China demand, yeah, we saw a downtrend, now it's stabilizing, so let's see if this can go back up. Gold imports are actually also stable. Silver imports up, so not too bad. SLV declining a bit, so some weakness in silver. Silver went below 30 for a few days. Now it's back above 30. What else? COMEX silver starting to rise. That looks good. But this is a new chart. Yeah, the amount of gold in as a percentage of reserves probably trending up in the coming years, so that's good for gold. I think I updated this chart. This tells us that we are in an inflation cycle where bond yields go up and gold goes up with it. China just released data that they bought 10 tons of gold this month. I think it's going to be much higher because they don't report all the purchases, probably around 60 tons per month instead of 10 tons per month. So they are buying. They're back to buying. And as you can see here, gold reserves are rising 4.6% in October, probably rising more. So they want to get rid of the bonds and get into gold. That's also why you see the 10-year bond yield going up. So I would avoid bonds at this time. US mint sales were zero, which is very odd, but they were zero at in December. Premiums not too good, low premiums still, so retail is not buying yet. The Shanghai gold premium was almost at 1%, so about 0.5 to 1%. That means that this is a bottom. Gold should be going higher. I think 2,800 is the near-term target. Silver as well, you can see premiums are very elevated. So 32, 34 is possible. Yeah, retail premiums still low, so no retail buying in the West. COT report, you can see here the open interest is at the lows. So that means, and this is correlated to the gold price, this should maybe go back up, open interest going back up, and that means gold shooting higher to new all-time highs very soon. A lot of non-commercials, I mean the commercial shorts have covered. So we're back at the neutral price. That's good. Smart money for gold. Latest update was that it's a bit down, but it's still above 50. So there's still momentum upwards. Swiss franc not doing that great. Yeah, the tips also not doing that great, but if this reverses, then gold will go up. We will see that when inflation goes up and rates get cut. Not sure if they will do that many rate cuts, but it looks like stocks are a bit iffy now and they will need to cut rates. Daniel DiMartino Booth said that we would have 5 rate cuts this year. So much more rate cuts than they say. We are currently in January, so expect at least two months of upward movement in gold. Silver the same, should move up now. And then we have some, okay, the bullish percent index, it was very bearish, so I think the bulls will come back in the gold space. Still a lot of upsides to 3,000, 4,000 in the long term. Stocks are to be avoided because they are above this currency in circulation line. So avoid stocks and get into gold. This trend should go up again at some point, and that will drag gold higher. That is very high. It's still rising. Deficits are still rising, so that should be good for gold. Rising like this. Near-term forward spread has actually gone above 0. So that's important to watch. So we are actually now at these points here. When the near-term forward spread goes above 0, you typically get into the recession. Okay, these points here. So we are currently here above 0. That means this is the perfect time to be in gold, because every time we get this recession, gold goes up. Okay, it always goes up. So this is no exception. Gold will go to 3,000. And we are going to get rate cuts, 5 rate cuts this year. And stocks will go down. Gold will go up. Sometimes it's really easy. So this is the path of rate cuts. Up, down, up, probably now down. And that will push gold higher. The bank term funding program is now at 0. Good. They managed to pay it all back. The cash is now very low. Liquidity is low. That should be a problem for stocks. Gold futures curve is doing very well. So for January, you can see it's up. This line is up, and it's actually much steeper than before. So I expect gold to go higher. Silver the same. January is up, but not as pronounced as with gold. Gold looks better. We are going to 3,000 here. Silver might go to 34. VIX has gone down again, so I expect a spike in the VIX, and that will be good for gold. Okay, it's pretty low. Whenever these spikes come, then gold should outperform stock prices. Okay, and you can see that here already. Yeah? Gold divided by stocks is rising, right? Trend is up, and I expect this to continue. This is a new section. We're currently here somewhere. This should be bearish for silver, but silver did go up, so looks like gold and silver are pretty strong right now. Onto some charts. Money supply is rising again. That's good for gold. Central banks are still in QT mode. I don't think they can go on much longer like this because liquidity is draining out of the system. So at some point they will start QE again, and that will be very inflationary. You can see here they are selling, still selling. It's not selling, apparently they are just letting it mature, but that's the same. There's no support for bonds and mortgages. So that's why the yields are going up. And as long as they keep doing this, yields will keep going higher. And with QT, you are going to see reserves dwindle lower and lower. It's already below 3 trillion. So if they get below 3 trillion, a lot of bad things are going to happen. So I would not be in stocks. Let's see what's happening here with the excess reserves. Deposits flat, loans still rising, so no problem yet. So watch for this to roll over and then the steamroller will arrive. Okay, on to deficits. Deficits keep on rising. Current account is down. Trade balance also down a bit. Okay, so looking good for gold. We want this to go this way. And services are in surplus, pretty stable, but in goods it's headed down, so more deficits. Latest data on air freight. You can see the trend. The trend is down, so more deficits are coming, especially when Trump is president. Export-import prices are up, so inflation coming back. This is November. Import prices actually up more than export prices, so more deficits. For the commodities, we see also prices starting to rise. And this is import and exports. Q3. It's rising, which means there's still growth. So we're not in recession, actually. We will see. Maybe it will roll over in this quarter. So deficits keep on rising. This should be bad for the dollar, but the dollar has not rolled over yet. I think it will roll over at some point. There's no other way, and I think it's going to happen when QE is announced. Capacity utilization, let's see. Yeah, this is a problem. This chart, I cannot scroll it anymore, apparently. So I will need to update this. So no data on this. Tariffs. So tariffs are actually bullish gold because it will increase inflation and reduce GDP. Okay, so that means there's more stagflation. And look at this, the proposed tariffs are huge. If they get these amounts of tariffs, and look at this, this is the depression, the Great Depression. And in that period, gold was going up 2-3x. So yes, please, let's do these tariffs, and then gold will go up multiples. So that's what I'm positioned for. Hong Kong housing is still busting, and this was a nice chart. When you compare, let's close it again. When you compare the residential prices versus the rents are is the red line. There you can see it was always correlated, and then prices went up much more than the rent index. So now we are reverting to the mean, and you can see that house prices can still go down like 30%. Okay, so that's what I'm expecting. Hong Kong housing will drop along with Chinese housing, I think. And all of those Chinese will need to buy something else, and that will be gold. So I don't think they will get back in real estate anytime soon. US dollar should drop. I think so, because this is completely overvalued. 20% overvalued, then we should drop back below 100 at some point. So that would be very good for gold. China. Let's talk a bit about China. We see that they are already using the amount of energy similar to the European Union. So I don't think that these Chinese are going to be using more energy than the European Union at some point. So they are already very close to the maximum energy use per person. You can already see that here. Power consumption has gone up, but it's starting to break down here. You can see that here. The population is also going down. So are they going to use more energy? Not really sure. When you look at the population, which is going to go down in the coming years, this could be a turning point for commodities, energy and commodities coming from China. Okay, and we know that China drives the commodity prices. If this rolls over, that will not be good. Reverse repo playtime is over. Yeah, I talked about this. So reverse repo is almost at zero, and bank reserves are going below 3 trillion. So that is not good for stocks. Liquidity is deflating. I also talked about this one. Stock bond correlation is positive. Expect bond yields to go up if there's no QE. And this will drag down stock prices because we now see that bonds are actually more undervalued than stocks. That's 2 decades already. In 2 decades before, stocks were actually undervalued. Okay, so since 2000 to 2024, stocks were actually undervalued, but now stocks are overvalued compared to bonds. So if bond yields keep on going up like this, then bonds are going down in value, which means that stocks will also go down in value because bonds are undervalued compared to stocks. So important to watch. If bond yields break out, stocks will crater. And the only thing that can save you is gold. Okay, so gold goes up when bonds yields go up or bond prices crater. So that's what I'm positioned for, all in gold. Now oil, you could also argue maybe we should buy oil. I'm not out of this conundrum yet. You could say the US dollar goes down, so asset prices go up, including oil. I agree with that. But I don't like to see this, where OPEC could increase production. So supply is supposed to go up more than the demand, and that should be bearish for oil. So I don't like this chart. So that's why I'm avoiding oil for the moment. Yeah, China energy per capita, already talked about that. Look at this, China steel production is also topping out and dragging everything down. Zinc, nickel, coal, all of that is being used in steel production. So commodities as a whole are very weak at this point. Okay, this is the same chart. Import losses, yeah, that was the new chart that I added to the checklist. Let's end it with this 60-40 portfolio. This is probably the most important chart, okay? Most of the people are in this 60-40 portfolio with stocks and bonds, no gold, okay? I think that this chart, gold vs 60-40 portfolio, is going to start rising. So stocks and bonds go down, gold goes up. So that means that this chart will go up in the coming years. You can see the allocation to gold is very low, and this will start bottoming out now and go up, like here in 2010 and 11. And the only place to be is in gold miners and gold. So avoid the 60-40 portfolio, because both of them will be cratering very soon. You can see already bond yields are starting to rise, stocks beginning to have difficulties, and gold keeps on going up. So conclusion, what is the conclusion of this episode of the Gold Forecaster Index? Yeah, really easy. Gold is the only alternative. There are no other alternatives to invest in. Basically, gold is the only thing that we can hold right now. And when you look at the long-term chart, it looks good. Okay, it looks good. Cup and handle, breakout. How high will it go? I think 3,000 is very much possible. So I sleep like a rose in gold miners. So let the others be in stocks and bonds, and they can have nightmares. So that's the end of this video, and I'll see you next month.